Hey guys, what's up? Nico again here. And in this 3D printed profits episode is going to be a little different. I have with us Mike. Mike, how do you say your last name, bro?
Check.
Yeah, I was going to butcher that.
You wouldn't be the first one.
There's no way. That's why I was like, just you say it. All right. So we have on Mike, and he's going to talk to us about tax planning. Something that we both had talked about it before we started recording. It's something that even I didn't think about when I first started, and it's something that is extremely important, you guys. Um, don't mess around with the IRS. Just don't do it, right? The IRS is essentially the world's biggest mafia, if I'm gonna categorize it in such a way. So, Mike's gonna help us talk about how to plan for that, how to structure your business, so on and so forth. So, without further ado, before we start, make sure you guys join us in the 3D printing side hustle group. The link for that is in the description below. So that's where we talk about just like this: taxes, production, printers, marketing, all those ideas. So make sure you guys join us. The link for that is in the description below. And let's start. Mike, welcome to the show.
Yeah, thanks for having me.
So, let's start here, man. When you say tax planning, give me that in a nutshell. What does that mean?
Yeah, so tax planning is simply the act or practice of making sure that you're putting strategies in place to pay the least amount in taxes as legally possible. And so most people, when they hear tax planning, they think of, well, I need to pay estimated taxes, or I need to pay, this as a business owner. And we say, well, that's all important, and sure, that's planning. But where we want to focus on is what things can we do in our business to make sure that we're paying the least amount in taxes legally possible. So we're not talking about, estimating how much tax we need to pay. Important, need to do that, great. But let's take it a step further. What can we do to make sure that tax bill, instead of paying 100,000 that we need to pay, how do we lower that to 50? How do we lower that to 30? How do we get that tax bill as
Yeah,
low
hook
as
me
legally
up.
possible?
I don't like taxes. I don't know one person who likes taxes. So let's do that. So how do we start tax planning?
Yeah, so I always like to kind of start with a concept. And when we look at tax planning, we have what we call core tax strategies and advanced tax strategies. So core tax strategies are strategies that can be implemented at any income level. Whether you're making $5,000 a year or $1 million a year, core tax strategies can be implemented. Easy to understand, easy to implement. Advanced tax strategies, and we always say let's maximize core strategies as much as possible. Advanced tax strategies are going to be for those higher income earners. Usually we say $250,000 to $300,000 or more is where we look into advanced tax strategies once we've utilized core strategies as much as possible. So, but when we look at core strategies, I always like to start with a simple concept, because a lot of what we do or what we implement plays off of this concept. And it's this idea of after-tax versus pre-tax dollars. So if you're a W-2 income earner, you're used to have what you call after-tax dollars. You have your gross salary or wages, whatever that is. Your employer takes all these taxes out, and then whatever's left over is what you get as a paycheck, and that's money's already been taxed. So
Mm-hmm.
you go out to lunch, you buy a computer, whatever you do with that money, it's money that's already been taxed. But as a business owner, things are flipped a little bit differently. We have sales or revenue, and then we have all these expenses that go into the business, and then whatever's left over from that,
Is
we get
taxed.
taxed on. So we like to flip the switch and say, how can we shift things from typically being after tax dollars into pre-tax dollars? How can we find a business purpose for spending that we might already be doing and move it from an after tax dollar to a pre-tax dollar? And so we saw this a lot in COVID. If COVID hit, you got sent, and you're a W-2 employee, you get sent to work from home. Now you're using a home office, you're using a desk, you're using your internet.
Mm-hmm.
You get nothing for that. You're using after-tax dollars for all those expenses that you're paying for now being at home. But as a business owner, we go work from home, we get a home office deduction, we get a part of our utility bill, a part of our cell phone bill, that
Your
desk and
water
chair and
bill,
computer, everything we
everything.
bought, we get a deduction for that. So
Part
that's a
of your home,
simple
part of your mortgage.
Exactly. And so that's the simple concept of moving things from after tax to pre-tax dollars. And so that is what we call maximizing deductions. And so many people, when we talk about maximizing deductions, they think, well, I need to go and buy something I don't need, or I need to go buy a new vehicle. I don't really need a new vehicle, but I need a tax deduction to lower my tax. We said, no. That's not what we're talking about.
So is
Let's
this
look
all still
deeper than
core
that.
strategies or is this advanced now?
This is all core strategies. This
No
is kind of
kidding. All right.
the
I like this.
core
All right.
concept to core
All right.
strategies.
So Mike's saying don't buy a car just to lower your tax bill. Okay. Bad. Don't do that.
Exactly. Now, if you need a car and you have a business purpose for it, yeah, go utilize the tax code for that advantage, but don't buy something you don't need to get a tax strategy. That doesn't make sense. You're saving, you spend $1,000, you save $300 in taxes, but you just spent 1,000. So you're looking at, you're out money, even though you had some savings in taxes. So that's the concept we talk about, and we take that concept and take it further from there. Let's say you have kids. How can we hire your kids in your business? You're going to be paying for basketball camps and sending your kids to amusement parks and all these other things with their friends. Instead of using after-tax dollars for that, why don't we find a way that we can hire your kids in your business? You get a business deduction. Your kids potentially pay no taxes on that income. And then they go and pay for their basketball camps. They go and pay for their amusement with their friends, or we fund retirement accounts with it, whatever it might be. So again, it's just a simple concept of moving things from,
like music to my ears.
Yeah. So it's just a concept for moving things from after tax into pre-tax.
And this is all still core strategies.
Exactly. Yep.
Holy cow. That sounded more advanced to me, if I'm being honest with you.
Well, we say core because we call them core because we say that no matter what your business size is, you can do it. If you're making $5,000 a year, you can have a home office. You can hire your kids in your business. If you're making $1 million a year, you can have a home office. You can hire your kids in your business. When we talk about advanced, they typically are going to be reserved for higher income earners, people that are going through a business sale or selling a highly appreciated asset. We see a lot of crypto where people have massive gains on cryptos, and how can we help attack the tax liability from that? So that's kind of the advanced side. We say it's more for that higher income earners or people that are going through a sale or of a highly appreciated asset. But these core strategies are things that we can do at any income level.
Okay. So let's continue with that, man. What else can you tell us as far as transferring over to pre-tax dollars rather than post-tax dollars?
Yeah. So, one thing that I want to talk about is one of the core strategies, and I think this is really relevant to your audience, is a lot of people come to me and say, Mike, when do I set up an entity? Do I need an LLC? Do I need a corporation? What's this S corporation thing that you talk about? And so I think that's important for people that are doing side hustles and understanding, okay, when does it make sense to start an entity? Do I need an entity? And, I'm not an attorney, so I can't tell you, say anything from the legal standpoint. Obviously having an entity helps with some liability protection, but my focus is more on the tax side. Does opening an LLC create any tax savings for you? No. Operating as a sole proprietorship or a single member LLC, you're taxed exactly the same way. But what I do say is one of our core strategies, we say it's almost like the core of our core strategies, is this idea of an S corporation. And in order to have an S corporation, we need to have some type of entity structure. An S corporation is just a way to be taxed. And so just to put things in simple concepts, if you're operating as a sole proprietorship, single member LLC, you pay your normal income tax rate, whatever that might be for your income level, plus you pay self-employment taxes, which is 15% on 100% of your business income. So you're making $80,000 a year in your side hustle. You're going to pay self-employment taxes of 15% on that 80,000 plus your normal income tax rate. And this idea of an S corporation helps reduce that amount of self-employment taxes. We can't touch your income tax rate. That's kind of going to be what it is. And we can implement strategies, maximize deductions to try to lower that income as much as possible. But your self-employment tax rate is something that we can help reduce or lower that 15% utilizing an S corporation. But with that being said, like an S corporation typically doesn't make sense until your business is profiting $50,000 or so dollars per year. If you're under that, S corp doesn't necessarily make sense or might not make sense in your specific scenario. So when clients come to me and say, hey, when should I open up an LLC? I say, well, is this business going to be something that you really think is going to take off? Or are you just kind of testing the waters? Do you have a wild idea? If you just have a wild idea from a tax standpoint, maybe just stay as sole proprietorship. But once you get to the point where you're like, yeah, it's starting to generate some income. An LLC, one, as an attorney can tell you, might help for liability purposes. But two, by having that LLC structure, now we know that once you hit that $50,000 or so in profit, now we can elect S corp status. If you have no LLC, if you have no entity structure, we can't be an S corporation. You need to be an entity first. So that's just one thing I always tell someone, you don't necessarily need to rush into these things from a tax standpoint, but you might want to start to set it up, especially as things start turning. I don't know how many people came to me in June and said, I'm going to have a blowout year. I started out this year, didn't know if my business was going to do anything. Now I'm going to make $150,000, $200,000 this year. And what can I do? Can we do an S corporation? And I said, well, you're a sole proprietorship. We can't do that S corp election. Now we can look into other tax strategies, but we can't do that S corp election until you have an LLC structure. So in June, they come up, they create an LLC. And from June forward, we can choose S corp status if we want. But January up until that point, we're stuck with that sole proprietorship, paying that self-employment tax.
Okay. Is it difficult, or is there a lot of political red tape or whatever that we need to go through to go from an LLC to an S corp?
Yeah. So an LLC is not difficult. An LLC is what you would remain. So if you open up an LLC with your state and you want to be an S corporation, you're still an LLC. You're just an LLC that you're electing to be taxed as an S corporation. So you still remain an LLC, name change, EIN, everything is the same with that LLC. Now we're just choosing to be taxed as an S corporation. And so there's two main downfalls of an S corporation. One, we just file a form 2553 with the IRS saying, hey, we want to be an S corporation. Here's the dates. And there's some complexities to that form, but overall, it's just filing that form, nothing too crazy. The other downside is you have to file a separate business tax return. So instead of filing on your personal tax return, now we're filing a business tax return. Still going to flow through to you personally, but there's some cost associated with that. And you also have to run payroll. You have to hire yourself in your business as a W-2 employee of your business, and you have to pay yourself a reasonable salary. So two downsides are separate business tax return, and you have to run payroll, pay yourself a reasonable salary. Because of those two, those will have some costs associated with them. And those two reasons, I always say, don't do an S corporation until you're about $50,000 in profit.
Okay.
Because if you're at 20,000 and now you have a separate business tax return, you have to run payroll, your tax savings are going to get eaten up with some of those additional costs that you have. And so we don't want people to rush into that, but having that entity structure, having that LLC ready, and then we can make that election whenever it makes sense, whenever you do reach that income level.
I see. Now, for the hiring, is that where the hiring the kids thing comes in for the S corp?
No, so the hiring the kids, if you're operating as a sole proprietorship or a single member LLC, you can hire your kids directly within your business, and you would still have to pay them a W-2. But here's the cool thing about hiring your kids: if your income is under roughly $12,000, a little bit over 12,000, but let's just use 12,000 as a number. If anybody in America, your income is under $12,000 and you have W-2 income, you pay 0%. You pay zero taxes on that. You're in the 0% bracket. So you can make $8,000 a year, W-2 income, pay no taxes on that. The other cool thing is that if you're a single member LLC or a sole proprietorship and they're your direct kids, you don't have to do Social Security withholdings. You don't have to do Medicare withholdings. You don't have to do federal unemployment. So basically, you could pay your kid, again, assuming that you're paying them a reasonable rate, you have a job that they're doing, they're actually doing work for you. Making sure we touch the bases there. I want to say you can't just hire your kid and have them do anything. But we're hiring your kid for reasonable stuff. We could pay your kid up to $12,000, get a business deduction for that, and they're going to pay no income taxes on that. Dude, they don't have to pay federal taxes.
You are so doing my taxes. Like,
we don't have to do Social Security. We don't have to do Medicare because you're your direct dependent. This is up to the age of about 17, 18. And normally we say you can start to do this around the age 7. Some people do it lower, but there's just tax cases that support age 7 as being an age where we can start hiring our kids.
Okay.
And so this is like very stuff that we can implement, again, regardless of your business level. And it's just shifting. You're going to support your kid. You're going to do those things. Now, you can't use those money to have your kids then go buy groceries for the family or stuff like that. But going to basketball camps or going to an amusement park with their friends, that's all fair game of what they can be using those funds for.
Okay. Now, is there what is the maximum age for these kids to be employed?
So typically we say hire your kids up to the age of 18. So 18 and under, or under 18 is when we can hire our kids in our business. Now, but it doesn't stop there. we would still very likely hire our kids once they go into college, once they turn 18. It's the strategy just might change a little bit because once they get into that age, no longer are they a dependent of yours. And so now, we might be paying some Social Security and Medicare, which is just some additional tax, still a great benefit. We still get a business deduction from it, as well as once they start to earn some more income, they're going to go above that 12,000 mark from the job that they're in. And so, that version of the strategy ends at, once they turn 18, but it just flows into a different type of strategy. We see this a lot too with grandparents. If I'm a grandparent and I want to support my grandchildren, I might pay my son or daughter a fee to do advertising, which my grandchildren are helping me with. And then my son or daughter is going to pay my grandchildren. I get a business deduction. My son or daughter is not paying any taxes on the income they receive because they're sending it straight to their children for the work that they're doing. So there's different variations of it depending on the specific situation, but the concept is still relatively the same.
Dude, okay, when we get off this call, you're doing my taxes, Mike. I've decided. Okay, you guys saw it right here. Said it. Mike's doing my taxes. So let's talk about deductions, right? So I make toys, okay? And so what I do, I make toys and I make props, right? And what I do is when I go to Disneyland or, my family vacation, I mark it as R&D, research and development, because I see what props, what new statues there are, the toys, so on and so forth. Now, is that something that we can write off? Because it is for the business. Like I am using it as research to develop new toys, to have new ideas. And my wife is my bookkeeper. So, I mean, does that count?
Yeah. So let's go back to the idea of after-tax versus pre-tax dollars. And so
Okay.
travel, what you're referring to is absolutely something that we say, let's utilize this. How can we at least deduct a portion of the travel that we're going to do anyways? We're going to go to Disney with our family. How can we deduct at least a portion of that as a business expense? And so what the IRS says is that in order for a day to be considered a business day, you have to spend the majority of that day on business. And when they talk about majority, they're talking about 4 hours and 1 minute. They look at the day as an 8-hour day. If you spend 4 hours and 1 minute, you spent the majority of that day on a business activity. So that could be meeting a client, that could be, exploring, buying product, whatever it might be. If you spend that's considered a business day. The IRS doesn't care what you do after that. You go to the beach, you go to Disneyland, you go do whatever after that. They don't care because you've already got your one business day in. You're the full majority of that day in for the business. So to go back to your question, obviously we don't know the full details and everything about that, but I definitely think there's some deductibility there. Maybe not the full trip, but there is some areas that we can get some deductibility there. The other thing too is that, let's say you're going to Disneyland and you would typically, let's say you're meeting clients or vendors or whatever it is, and you would typically just get a normal hotel room for yourself for that. But now you got your family with you, so you're getting the suite, which is 3 times the price. In that situation, what the IRS would say is, okay, that's fine. We can still consider this a business trip, but we can only deduct up to what would be reasonable for just you. So the cost of one hotel room, that's going to be deductible in full, but the suite, that difference between that and the suite might not be, because your family wasn't necessarily needed for that business. Now, let's flip the switch though. As we start to bring our family into our business, we hire our kids in our business, maybe we are turning more of those trips into full business trips. And so then we're looking at that a little bit differently as well.
Because they're an employee. Is that why is that the thought behind that?
Well, that too, but we have to say, what are we doing this trip for? If it's for entertainment, then entertainment's no longer deductible even for business owners. But can we find a business purpose? Are we scouting for different things? Are we meeting with vendors? Are we meeting with clients? Well, let's try to document that business purpose. If we can find a business purpose for it that's ordinary and necessary in the type of line of work that we're doing. So is it ordinary? Are other businesses in this industry doing that? And is it necessary? Like, is this necessary to be able to build new toys? Is it necessary to get new clients? Whatever. If we can say it's ordinary and necessary, let's document that. Then we can take it as a business deduction. So it would just need to be clear of, okay, what is the business purpose of this? Is it just to go on a bunch of rides and then look at a few statues? That might be tough. We might be tough to take a whole full deduction there. But are we doing some work? Are we meeting with some people at Disney? Are we meeting clients, vendors, different things like that? And we're spending a good amount of time doing that on a regular day-to-day basis. And then once we've got our business hours in, now we're going on rides. Completely game changer. We can go on rides, we can have those things, but we still have to consider days, business days or not. And that's where, how much time in that day are we spending on business?
I see. Okay. So it's within reason of the business day, right? For the majority, right? It has to be within
Mm-hmm.
reason.
Yeah. I always say do the sniff test on a lot of these things. One, make sure you do the documentation. Write down what were you doing, why were you there, what are some outcomes of it. Just document that. You're probably never going to need it, but if you need it, you have it. So do that, some of that documentation, and then do the sniff test. If someone is trying to say, yeah, this isn't a business expense, how am I going to defend that? How am I going to explain to them that's a business expense? And most people, if you're trying to try to read between the lines and get away with something, you're going to be like, yeah, it's going to be really tough to explain that. Other times, though, it's like, no. Here's my documentation. Here's the support behind it. Here's my reasoning. And you feel like you have a really good case against someone that's trying to say that that's not business. Just do some of the sniff tests to determine that. Again, document things. You may never need it. You may never get audited. They may never ask about it. But if they do, you have all this documentation ready. It's just like, here you go, IRS. I'm not worried about an IRS audit because I have everything ready for them if they come knocking. The last thing you want to do is 3 years from now, someone asks you, hey, what did you do on August 27th on that Disney trip that was business related? And you're like, oh man, like you're making stuff up now. And so do some time when you're there, do a little bit of documentation, put it on file, and you'll be able to sleep better at night knowing that.
There you go. Cool, man. Um, this is incredible. I mean, it is before we leave, I want to hear one advanced strategy, right? So there's high income earners. Is that something that would apply to us who have a side hustle? So my side hustle has grown to quite a big number. And I'm looking at this advanced strategy, like I'm intrigued. So can you give me one that might apply to a side hustle that's grown pretty significantly?
Yeah. So the cool thing about advanced tax strategies, oftentimes it doesn't just have to be business income. So a lot of times we're looking at the strategies that we can implement can help offset W-2 income as well. We do this a lot with doctors, attorneys, lawyers, things like that. People that have high income earners, but they're W-2 employees. So many people think I'm just a W-2 employer. All my income is wrapped up in W-2. So there's not much tax planning that I can do to help reduce that. We're saying, no. As long as you're in an income level that makes sense, which typically we say $250,000, $300,000 or more, it opens up the door to advanced tax strategies that can offset household income, business plus W-2 income. And these strategies, they're a little bit more complex, where we really want to start vetting them, working on them, making sure that we're doing and implementing them correctly. But they have all sorts of different types of strategies in this area. A lot of times we're looking at some type of charitable type planning. So we're utilizing a charity or some type of charitable gift of some sort to produce a tax savings. Other times we're investing in real estate or solar projects around the country, and we're utilizing some of the benefits of depreciation and things from those projects to help offset some of our income. So when we look at advanced tax strategies, traditionally there's going to be, again, a little bit more complex, potentially an investment or some type of out of pocket that needs to go into it. But then we utilize that to hopefully create some separation where we can say, okay, we're going to flip our tax bill. We're going to trade in our tax bill. Let's say your tax bill is $100,000. We're going to invest in something for $100,000 that's going to eliminate our tax bill, or maybe give us, 200% ROI on that investment. So there's all different types of variations and different things that you can do as far as the strategies involved. But traditionally, it's usually going to be based on some type of charitable giving of some sort. So we're utilizing the charitable deduction in the tax law and taking advantage of that. Or we're doing some type of investment, which could either be solar, where we're taking advantage of solar credits and depreciation. investing in real estate where we're taking advantage of depreciation, some sort of combination or of that as well.
I see. So all of this, Mike, do you do this all in-house? Do you have like a team that does it? You have a full firm?
Yeah, so we have, our small business tax savings podcast, which is where we do weekly episodes, share about tax strategies. Most of what we talk about on there is going to be what we call our core strategies. So, you can look at 4 years of content, find some really good tax strategies on there and blog posts that go along with it. On the back end of that, we have two different things. We have our tax minimization program, which is a do-it-yourself training program. We deep dive into these strategies, but you also have access to lean on us for general questions when they come up. And then on the back of all of that, we partner with an accounting firm that does bookkeeping, taxes, payroll, and kind of everything for small businesses, which is more of a full service. So you can either be free, listening to the podcast, learning from there, do it yourself, which is kind of just a monthly membership, or completely done for you or done with you services. And really, we come in, we help as little or as much, as much or as little as somebody wants. So some clients we do everything for. Other clients say, hey, I have a great tax accountant, but they just don't do tax planning with me. They don't really go through these strategies. Can you help me out in this area? And we say, yeah, absolutely. We'll partner with you on the tax planning side. You work with your accountant on the tax filing side. And, we'll work with your accountant directly to make sure that we're all aligned in that area. So like I said, wherever you are in this journey of being an entrepreneur, as being a business owner, we can come in and help somewhere along that line.
Every link you have, Mike, please. I need it. I need it in the description. I'm personally going to talk to you right now, offline. Mike's going to do everything for me. Okay, you guys, so here's a hot tip, okay? There's a time where your time is best invested in just growing your business. There's a time where you just let experts like Mike do it all for you. I understand you save a lot of money by doing it yourself, but where are you needed most? Okay. If you working on your business makes you more money than what you pay Mike, do that. Okay. Don't be cheap. If there's a service that you need done and it's going to be done properly and correctly the first time, just go do it, pay for it. I'm going to. Mike, thank you for being on the show. That was amazing content. I'm super excited about it because I'm not a fan of taxes. I don't think anyone really is. So again, Mike, thank you so much for being here. I really appreciate it. Make sure you guys tune in Monday through Friday, 6 a.m. Pacific for more episodes just like today. Mike, thanks for being here, man.
Thanks for having me. I really enjoyed it.